It's time for another Friday update on Canadian housing, and as you may have noticed, it's sweater season, bitches! Let's get sweaty. I've got 4 stories for you today, most of which could probably be an entire video in their own right, but you'll get the short versions for now. First up, Hamilton's vacant unit tax was quashed in a surprise vote on Wednesday after having been approved by Council back in January. The vote on Wednesday was initially slated to be a vote for final approval of a bundle of previously agreed upon bylaws. This is usually a rubber stamp vote of approval because everything in the bills was previously debated and ultimately approved by Council. However, Councillor Tom Jackson pulled the vacant unit tax bill for a separate vote. This is unusual, but does sometimes happen when a councillor wants a vote on a specific item to be on the record, but it very rarely results in an already decided item being overturned, but it did happen in this case. So why pull this bill at this specific time for a new vote? Well, some councillors said it had to do with being unhappy with the details of the implementation. But many have speculated that it was due to Progressive Councillor Narinder Nan being absent for the vote because she was tending to some matters for her mother, who has been in the hospital. Councillor Nan was not informed of the new vote, and there was no debate or discussion on the matter before the vote happened, so she was unable to log in time to vote remotely. The vote to approve the tax failed on a 6-6 tie, with Mayor Andrea Horvath unable to cast a deciding vote due to a declared conflict of interest, which is that she is currently the landlord of a vacant unit. However, after the vote, the acting city clerk noted that a bylaw can't be struck down at council without a reconsideration of the original motion that led to the bylaw, so the issue should be coming back to council for further debate in December. At the risk of editorializing, I would think that if the problem was the specific details, there would have been time over the past 10 months to address those individually and retool the bylaw to resolve those issues in advance, rather than axing the tax entirely. It seems to me this was more like taking advantage of procedural issues to torpedo an agreed-upon bill at the last second. But hey, that's just my opinion. Now, in general, I don't really care for politics or politicians, but this is a good example of why it's important to stay up to speed on your local municipal politics. Although federal politics tend to dominate the discussion, municipal politics arguably have a bigger impact on your daily life, and you definitely have a greater ability to influence things as a citizen. Next, the federal government introduced the Canada Mortgage Charter in the Fall Economic Statement, supposedly to help borrowers continue to pay their mortgage and stay in their homes. There's 6 items in the guidelines, most of which already existed, but they've now been compiled in one place. This is also not actually enshrined in law, it's more like a series of recommendations on how banks should treat their customers according to the government. This announcement has been called a nothing burger by industry commentators such as Ron Butler and Dan Foch. Foch? I don't know how to pronounce your last name. But anyway, because there's very little new in it, it doesn't seem like much of an announcement at all. One interesting addition is a requirement to exempt insured mortgage holders from requalifying with the stress test when refinancing with a new lender. This is one the banks will probably go along with because it will allow them to poach customers from other banks at renewal time, and the requirement is only for insured mortgages, which means the bank really isn't taking on any risk with the mortgage, so it doesn't matter to them whether or not the borrower has the capacity to keep making their payments in the long term. This one I think actually has some interesting broader implications, but I'll get into that later. Next, an update on the proposal in the 2023 budget to absorb Canada mortgage bonds into general federal borrowing. They decided not to go ahead with this plan, but instead do a 50-50 compromise and have the government use federal funds to purchase up to $30 billion worth of Canada mortgage bonds every year out of a total pool of $60 billion. Incidentally, the annual issuance used to only be $40 billion per year, but the government recently expanded the program by another $20 billion, supposedly to provide funding for purpose-built rental projects. Basically, they're continuing to tinker with the underlying mechanisms that fund mortgages in Canada. This is a very complicated and confusing subject, but try to stay with me here. For high-ratio mortgages, which are mortgages with a down payment of less than 20%, mortgage insurance is required to protect the lender in the event that the borrower defaults. The CMHC provides this insurance for a fee, which is passed on to the borrower by adding it to the principal of the mortgage. In order to raise more capital so they can issue more mortgages, the banks can take these insured mortgages and package them into something called an NHA MBS, which stands for National Housing Act Mortgage-Backed Security. These are sold to investors who provide the bank with capital in exchange for receiving principal and interest payments on those mortgages. Now, with those mortgage-backed securities, if someone defaults or prepays their mortgage, for example if they sell their house and go with another bank for the new mortgage, or if they refinance with a different lender, the bank doesn't have the interest payments coming in to make the payments on the mortgage-backed securities, which is why banks will charge prepayment penalties for paying off the mortgage early. But just in case, to make them even more attractive to investors and keep the flow of cash coming for high-ratio mortgages, the CMHC guarantees the payments for these NHA MBS products. The CMHC charges the issuer a fee up front, and then if there's any shortfall in mortgage payments, the CMHC will cover the difference so that investors still get their payments. However, even with all these guarantees, banks were still having trouble finding enough buyers for their mortgage-backed securities to keep rates low, so the CMHC stepped in again and created the Canada Mortgage Bond Program. With this program, the CMHC buys up excess NHA mortgage-backed securities, combines them in the Canada Housing Trust to spread out the risk, and they raise capital to buy these MBSs by issuing Canada mortgage bonds, which are a plain vanilla bond that pays out a fixed amount which is guaranteed by the federal government. This is another way to inject liquidity into the system and make sure that banks always have enough money to lend to insured borrowers. So basically, we're insuring a huge amount of mortgages, we guarantee the payments on the securitized financial versions of those mortgages, we buy a bunch of those securities and reissue the debt as regular bonds to provide liquidity to those mortgages, and now we're going to be buying up to $30 billion a year of our own bonds that provide the capital to the CMHC, and this is all supposedly going to save us billions of dollars on the bond spread between Canada mortgage bonds and Canada government bonds. Now, interestingly, this all links back to the mortgage charter stuff I talked about earlier, particularly the things about prepayment. If banks are being asked to waive prepayment penalties and borrowers no longer have to requalify when they refinance with a different lender, that's going to be a risk to the payments on mortgage-backed securities. But the government already insures the payments on those securities in addition to buying the securities and then again buying their own bonds that they use to fund their own purchase of those mortgage-backed securities. So in effect, all of the risk in this system is backstopped by the taxpayers, and the government is absorbing more and more of the whole mortgage ecosystem with each step. It's hard to say exactly what this all means, but according to the Ministry of Finance, this is all totally fine, probably even good. Finally, TD has doubled their forecast for a housing price correction in the medium term. In a recently released update, they changed their forecast for a price drop from Q3 of 2023 to the early part of next year from 5% to 10%, due to an upgraded bond yield forecast, which basically means interest rates staying higher for longer, as well as home sales slowing down more than they had expected. This may not seem like a large drop, and it would still leave prices at 15% above pre-2020 levels, but keep in mind that due to inflation, currency devaluation over the same time period has been about 14%. So again, the distinction between nominal and real dollars is important to understand here. That's all for today, so thanks for watching and enjoy your weekend.